Welcome to This Explainer. Today, we're diving into Emperador Inc.'s first half 2026 earnings report. And honestly, we've got a pretty fascinating financial mystery to unpack. If you follow the global distilled spirits market, you know Emperador is an absolute titan. But their latest filing presents us with a striking contradiction. A situation where making way more money at the top somehow resulted in keeping less money at the bottom. We're going to analyze the biggest surprises, the shifting revenue and profit trends, and piece together what management is actually doing behind the scenes. Here's our roadmap for today. We'll start by looking at the earnings paradox, investigate the segments, explain the OPEX spike, review the Fortress balance sheet, and finish up with what to watch next. Section 1. The earnings paradox, record margins versus shrinking profits. The latest numbers brilliantly illustrate our central mystery. You see, normally, when a company crushes it on the top line, we expect that success to trickle right down to the bottom line, right? Well, Emperador achieved a massive, nearly 17% surge in gross profit, hitting 9.47 billion pesos. That is a huge win. It significantly outpaced sales growth and expanded their margins. But here's the catch. Their bottom line net profit actually shrank by 6.4%, falling down to 3.73 billion pesos. So how on earth does a company expand its gross profit by over 1.3 billion pesos in just 6 months, but end up keeping less of it? To solve this puzzle, we first have to ask, is there a problem with consumer demand? And the answer is a resounding no. The sales volume is undeniably healthy. Sales of goods and services jumped nearly 8% year over year to a record 28.8 billion pesos for the first half of 2026. In fact, if you just look at the second quarter, sales surged 24% compared to Q1. So people are definitely buying their products. Demand is actually accelerating.
Section 2. Investigating the segments. Brandy versus Scotch whiskey.
To find out what's causing this profit drag, let's split the business in half. As you can see, both segments are absolutely thriving on top. Brandy saw external sales grow by 7% to 18.5 billion pesos, boasting a gross profit rate of nearly 30%. Meanwhile, Scotch whiskey is also growing beautifully. Sales are up 8% to 10.3 billion pesos, hitting a highly lucrative 38% gross profit rate. Both segments are enjoying a better product mix and strong cost efficiencies in production. But check this out. Despite that 38% gross profit rate, whiskey's EBITDA margin drops all the way down to 15%. This gives us a massive clue. Whatever costs are eating into these profits, they're happening after the gross profit line.
Before we dig into those costs, let's understand the momentum here. The brandy segment is completely dominating domestic demand right now. It's largely driven by a robust market in the Philippines for CLVB Emperador and Fundador Super Special, along with international contributions from Terry in Spain and El Presidente in Mexico. And the momentum is just huge. Q2 sales surged an incredible 23% compared to the first quarter, which drove a 20% year-over-year spike in first-half gross profit. Meanwhile, the Scotch segment saw a massive global rebound in Q2. And this wasn't just isolated to one region. The report highlights a broad-based geographic acceleration across the UK, the Americas, Asia, and even global travel retail. What's really moving the needle, though, is their premium single malt portfolio. That category expanded by 20% in just one quarter. This shift toward premium products is exactly why their gross profit margin for whiskey is sitting so high. Section 3. The OPEX spike explained, solving the mystery. So if both segments are selling rapidly and gross margins are expanding across the board, where exactly did all that money go? Well, management actually gives it away with these exact phrases in the report. They state this controlled operational expansion compressed consolidated net profit. If we translate that corporate speak into plain English, it means they are purposefully spending a fortune right now on infrastructure so they can sell a mountain of liquor later. This isn't some accident. It's a calculated deployment of capital. Here's exactly where that money went. In the second quarter alone, operating expenses spiked a staggering 48% compared to the first quarter. Those gross profits were heavily deployed right into commercial scaling. For the brandy segment, we saw massive increases in freight, salaries, travel, fuel, and promotional advertising to service all that escalating route to market demand. And for the whiskey segment, there was an intense strategic spend to secure long-term distilling and maturation capacity. That led to increased borrowing costs, meaning higher interest expenses from drawing down debt to fund massive global facility expansions. Add in some higher localized income taxes, and boom, you perfectly explain why the net profit shrank by 6%. Section 4. Fortress, balance sheet, Structural stability. Now, you might be wondering, is this safe? Whenever a company increases its operational spending and takes on debt for facility expansions, investors absolutely need to check under the hood. The good news? The data shows a fortress balance sheet. Emperador's current ratio sits at 4.57 times. This measures their ability to pay short-term obligations. Just to give you some context, a ratio of 1 is considered okay, 2 is great. Emperador actually improved their current ratio in this half to a rock-solid 4.57. Furthermore, their quick ratio, which measures immediate liquidity from cash and receivables, stands at a very healthy 1.5 times. Simply put, they have plenty of cash on hand to fund this aggressive expansion without running into any liquidity issues. They're also maintaining a highly conservative capital structure. Their gearing ratio, which is their bank debt-to-equity ratio, remains extremely low at just 38%. In fact, that's actually a slight reduction from the 39% recorded at the start of the year. So even though they're drawing down debt for facility expansion, their total equity of over 11 billion pesos easily absorbs it. They are scaling up aggressively, but for sure, they're doing it safely.
Section 5. What to watch next? Inventory strategy.
Taking all of this financial data into account, the record sales, the infrastructure investments, and that rock-solid balance sheet, it really all comes down to exactly where they parked 3.4 billion pesos in the first half of the year. Inventories expanded by 6% to a massive 59.4 billion pesos. But hey, this isn't dead stock. The report points out a 6% increase in the laying of liquids, which is just a really fancy way of saying they're putting spirits into barrels to mature for future growth. They also saw a massive jump in packaging materials and an 11% increase in finished goods. This is a highly calculated strategic move to prepare for advanced production. They're literally loading the cannon for the upcoming third quarter festivals. Which brings us to the ultimate question for investors following this stock. We've demystified the earnings paradox. They didn't just lose profitability. They consciously reinvested it into freight, marketing, facilities, and a massive 3.4 billion peso inventory buildup. So, I'll leave you with this final thought to ponder as we await the next report. Will this aggressive infrastructure and inventory strategy perfectly time the market, translating into a massive bottom-line profit boom in Q3? If their operational scaling works as intended, the back half of the year could be explosive. Keep a close eye on their next earnings release to see if this big bet pays off.